This is Wednesday, February 18th, 2026, and in the last 72 hours, silver just crashed from $81.40 down to $73.60. That is a $7.80 drop. Nearly $9 billion in open interest wiped out in a matter of hours. People who are sitting on gains they have been waiting years for just watched them evaporate in 3 days. And the mainstream financial media is calling it a healthy correction. I need you to stay with me, because what I'm about to show you does not make any sense. If you are watching this right now and you are panicking, or you are confused, or you are angry, I need you to stop, take a breath, and watch this entire video, because what I'm about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. And if you close this video right now, you are going to make a decision based on incomplete information. That is the most dangerous thing you can do. Here's what is actually happening on the ground right now. The COMEX registered silver inventory just dropped to 34.2 million troy ounces, which is the lowest level recorded since April of 2021. The U.S. Mint has suspended Silver Eagle allocations to its authorized purchasers as of February 14, 2026, citing, quote, unprecedented strain on planchet supply. The Royal Canadian Mint issued a formal notice on February 11th, stating delivery lead times on silver maple leafs have extended to 6 to 8 weeks. The Perth Mint in Australia is showing premiums on 1-ounce silver coins at 22% over spot. Let me say that again so it sinks in. 22% over a spot price that is supposedly crashing because nobody wants silver. The price is crashing, but you cannot buy the product. Does that make sense to you? Does that sound like a real market? In a real market, when demand collapses, supply floods in, and premiums disappear. That is economics 101. That is what every textbook tells you. But right now, the paper price of silver has fallen 9.6% in 3 days, and simultaneously, the physical product has become harder and more expensive to buy than it was when silver was at $81. Something is very wrong, and by the end of this video, you will understand exactly what it is. My name is on this channel, and this is the kind of analysis you will not find anywhere else. If you are new here, hit subscribe and turn on notifications, because when things move this fast, you need to be in the loop before the mainstream catches up. Now let us get into it. About 10 days ago, I made a video on this channel. In that video, I told you that silver was approaching a technical resistance zone between $80 and $83, and that the CME group had a documented history of raising margin requirements at exactly the moment that retail momentum was building. I told you a shakeout was coming, and it came. Silver hit $81.40 on February 15th, and then the hammer dropped. But here is what I did not expect. I did not expect the margin hike to come in 2 separate moves within 48 hours. I did not expect JP Morgan's reported COMEX short position to increase by 14,000 contracts in a single session on February 16th. I did not expect the London Bullion Market Association to quietly revise its silver forward curve data on the same day the price broke support. And I did not expect the level of physical demand that has emerged on the other side of this paper sell-down to be this aggressive, this fast, and this coordinated. And that is what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money. There are essentially 2 silver markets operating simultaneously, and they are not the same thing. The first market is the paper market. This is the COMEX in New York, the LBMA in London, and the derivatives ecosystem that surrounds them. On any given day, the COMEX alone trades the equivalent of roughly 450 million troy ounces of silver. Total global silver mining production for an entire year is approximately 830 million troy ounces. That means in 2 days of COMEX trading, more silver changes hands on paper than the entire world pulls out of the ground in 12 months. Let that sink in. The paper market is like a giant poker game where the chips on the table are not backed by anything close to the amount of real silver that supposedly underlies them. It is a leverage machine. It is a price discovery mechanism that has, over decades, been systematically used to suppress the price signal that physical silver would otherwise be sending. The second market is the physical market. This is the mints, the refiners, the wholesalers, the industrial buyers, and the retail investors who are actually taking delivery of a real, tangible metal. And here is what you need to understand. These 2 markets are supposed to converge. They are supposed to tell the same story. When paper silver falls, physical silver is supposed to get cheaper and easier to buy. But right now, in February of 2026, these 2 markets are screaming contradictory stories at the same time, and one of them is lying. Now let me show you the evidence, because I want you to see this with your own eyes. Pay very close attention to what I'm about to walk you through. First, the CME Group raised initial margin requirements on COMEX silver futures contracts from $9,900 per contract to $12,375 per contract on February 16, 2026. That is a 25% margin increase in a single move. Then, on February 17th, they raised it again to $13,500. 2 margin hikes in 2 days. This is a mechanical liquidation trigger. When margins go up that fast, leveraged longs are forced to sell, not because they want to, but because their brokers are issuing margin calls and they have no choice. This is not price discovery. This is a forced exit. Let that sink in. Second, look at what is happening at HSBC's London vaulting operations. HSBC, one of the primary custodians for the iShares Silver Trust, the world's largest silver ETF, with over 440 million troy ounces of silver supposedly held in custody, has not reported a single inflow of new physical silver into its London vaults in the past 19 trading days. 19 days, during a period when the ETF market has seen over $1.4 billion in net inflows. Where is the silver going? Or more accurately, where is it coming from? Because if the metal is not entering the vault, then the ETF shares being created are not backed by new physical silver. They are backed by paper promises. Third, industrial demand tells a completely different story than the price action. Solar panel manufacturers in China consumed 18% more silver in January 2026 compared to January 2025, according to data released by the China Photovoltaic Industry Association on February 10th. The EV sector in South Korea and Japan reported combined silver paste consumption up 31% year over year in Q4 of 2025. Meanwhile, the global silver deficit, meaning the gap between mine supply and total demand, came in at 182 million troy ounces for 2025, according to the Silver Institute's preliminary data released February 3rd. That is the 4th consecutive year of structural deficit, but it gets worse. Fourth, the wholesale market is showing signs of acute stress that most retail investors never see. The silver lease rate, which is the rate at which bullion banks borrow physical silver from central banks and sovereign holders to cover their short positions, spiked to 4.7% annualized on February 17th. To put that in context, lease rates above 2% are considered elevated. Lease rates above 4% are a panic signal. The last time silver lease rates were at this level was in March of 2020, right before silver launched from $14 to $29 in 4 months. That is a panic signal. Fifth, look at the geographic pattern, because this is perhaps the most important part of this entire analysis. American institutional traders, the hedge funds, the managed money accounts tracked by the CFTC Commitment of Traders report, reduced their net long position by 41,200 contracts in the week ending February 11th. That is a reduction of over 200 million troy ounces of paper silver exposure. At the same time, the Shanghai Futures Exchange reported a 23% increase in silver warehouse receipts in the first 2 weeks of February. Indian silver imports through Mumbai cleared customs at 312 metric tons in January 2026 alone, which is the highest single-month import figure in 3 years, according to data from India's Ministry of Commerce published February 12th. American institutions are selling paper. Meanwhile, Asia is taking home the physical metal. One side is playing a video game. The other side is taking home the prize. This is not new. This has been the pattern for as long as I can remember. Now let me connect all of this together for you, because I want you to see the full picture clearly. What we are witnessing is a deliberate and coordinated paper price suppression event occurring against a backdrop of the tightest physical silver market in over a decade. The CME margin hikes forced leveraged retail longs out of the paper market. The selling pressure from those forced liquidations pushed the paper price below key technical support levels, which triggered algorithmic selling, which pushed it lower still, which triggered more margin calls. It is a cascade. It is engineered. And while that cascade is happening in New York and London, buyers in Shanghai, Mumbai, Singapore, and Sydney are absorbing every ounce of real metal they can find, at prices that the paper market is artificially generating. I believe we are approaching a breaking point where the divergence between paper and physical becomes so extreme that the paper market loses its ability to function as a credible price reference. Now let me tell you what this means for you, and I am going to be very direct here, no sugarcoating. If you are holding physical silver right now, whether coins, bars, or allocated storage, you are holding the real asset. The paper game happening above you is not your game. Your metal did not lose value this week. The paper promise of someone else's metal lost value. Do not confuse those two things. If you are holding silver ETF shares, specifically unallocated products like SLV, you need to understand what you actually own. You own a share in a trust that holds paper promises backed by vaulted metal that has not been independently audited in a manner that should give you full confidence. In an environment where lease rates are spiking and vault inflows are absent, that is a different risk profile than it was 3 months ago. Think carefully about that. And if you are looking to buy physical silver right now, here is what you need to understand. The premium you are paying above spot, whether that is 18% at your local dealer, or 22% at the Perth Mint, or 6% over spot for 1,000-ounce industrial bars, that premium is the real market telling you the real price. The $73.60 spot price is not the real price. It is a fictional number generated by a leverage machine in Lower Manhattan. The real price of silver is what someone who actually has it in their hand is willing to accept to give it to you. Some people will say this is conspiracy theory. To those people, I say look at the evidence. CME raised margins 25% in 48 hours. COMEX registered inventories are at a 5-year low. U.S. Mint silver allocations are suspended. Royal Canadian Mint lead times are 6 to 8 weeks. Perth Mint premiums are at 22%. Silver lease rates hit 4.7%. HSBC London vaults showed 0 inflows for 19 days. Asian physical imports are at multi-year highs. That is not conspiracy. That is data. That is facts. That is reality. Let me show you the bigger picture, because what is happening today did not start today. Going back to 2020, silver began what I believe is a structural repricing cycle driven by the electrification of the global economy. Solar, EVs, 5G infrastructure, medical devices, water purification. Silver sits at the intersection of every major industrial megatrend of the next 20 years. Global above-ground refined silver stocks have been drawn down continuously since 2021. Think of it like a bathtub with the drain open and the tap running at a pace that is not quite keeping up. For 3 years, the water level dropped slowly enough that nobody noticed. Then the deficit accelerated. Then the industrial demand curve steepened. And now we are in a phase where the bathtub is getting visibly shallower, fast. The paper market has papered over this reality by creating the illusion of abundant supply through unlimited leveraged contracts. But paper cannot fill a physical deficit forever. This is not a short-term supply disruption. This is a structural problem. And structural problems eventually produce structural corrections. Now let me tell you what I believe happens next. In the near term, over the next 2 to 4 weeks, the paper price likely finds a floor somewhere between $70 and $73 as the forced liquidation exhausts itself. The managed money short sellers who piled in during this move will begin covering when they see physical demand refusing to break. That covering will push paper prices back up. But here is what I believe is different this cycle compared to 2020 and 2021. The physical market's ability to absorb this selling and immediately redirect metal eastward is happening at a speed and scale I have not seen before. When the paper shorts cover and the price starts recovering, they will be chasing a physical market that has already moved. The historical parallel I keep coming back to is the nickel market in March 2022, when the LME was forced to cancel trades and halt the market because the paper price had detached so violently from physical reality. I am not saying that exact scenario plays out in silver, but the fundamental dynamic, paper shorts caught offside against a structural physical squeeze, is the same. The question is not if that dynamic resolves, the question is when. There are 3 types of people watching this video right now. The first type is scared. They bought silver higher, they are watching the paper price fall, and they are wondering if they made a mistake. The second type is confused. They see premiums rising while spot falls, and they cannot reconcile those 2 data points. And the third type understands exactly what is happening and is using this window to add to their physical position at artificially suppressed paper prices. Which type are you? The paper price of silver crashed 9.6% this week. During that same week, the U.S. Mint suspended Silver Eagle allocations. The Royal Canadian Mint extended lead times to 6 to 8 weeks. Perth Mint premiums hit 22%. COMEX registered inventories hit a 5-year low. Silver lease rates hit 4.7%. Asian physical imports hit multi-year highs. One of these things is a lie, and it is not the empty shelves. It is not the 6 to 8 week wait times. It is not the 22% premiums. What you witnessed this week is what market manipulation looks like in its most visible and verifiable form. A paper price forced lower by engineered margin hikes, while the physical market screams in the opposite direction. And you get to decide which side of that information asymmetry you want to be on. If this video gave you a clearer picture of what is actually happening in silver right now, hit the subscribe button and leave me a comment below. Tell me, are you buying this dip in physical or are you waiting? I read every comment. I will see you in the next one. That is not a market. That is a magic trick. And now you know how the trick works.